Hello, everybody, and welcome to the third episode of the Angel Bricks podcast, the podcast designed to help everyday investors make better real estate investment decisions. Today, we're going to talk about something where, as a landlord, if you fail to do it, you are 100% going to fail. 100% guaranteed. Today, I've got somebody that we actually work with quite a lot. His name is Jaime Moreno. He works in asset management, real estate, and banking. Full disclosure, we work with Jaime. He's actually on our website, so we're bringing somebody that we already know. And today, Jaime is going to talk to us about the difference between a property manager and an asset manager. And I think that's a really, really important distinction. Hello, Jaime, and welcome to our podcast. So thanks very much for coming on. The first thing I think it would be useful for you to do is just introduce yourself and a little bit about your background and how you got to where you are.
Hi, Ashley. Good morning. Yes, thank you for having me in your podcast, first place. So, well, I'm Jaime Moreno. I'm the founder of a company called Acacias Capital, which is a real estate advisory firm based here in London, in the UK. And we service essentially investors from overseas, many of them from Europe, but our core client come from Latin America. And essentially what we provide are services starting from buying property for investors from different countries up to asset management and overseeing their investments in the UK. So we facilitate the whole process for them. It's been a business that has been in the market. I mean, we've been in the market for nearly 7 years now with this company. We are just opening an office now in South America with some partners over there because the demand is growing. And I come from the financial industry. That's what I was doing before, working in banking. So I think my approach, as a difference to essentially everyone else in this market, is more a financial and a strategic view of the investment rather than just thinking on a property and bricks and trying to rent that out. We look after that more as an investment, and that's why investors and all overseas investors like about our service, because essentially we are always taking, we are essentially wearing their shoes or their hat. We act as owners in the UK, like a multifamily, like a multifamily office.
Okay, no, that's really helpful, I think. And I think this is an important distinction because what we see a lot, certainly within our business, when investors come to us with, generally it's through exit, where they analyze their property and they work out it's not quite going as well as perhaps they would like. Generally speaking, there's always one mistake that they're making, which I think is probably the most important thing that investors need to realize. And that is that there's a difference between a property manager and what we would call an asset manager or a sponsor or a GP or whatever you want to call it. And that is somebody who is facilitating the actual investment itself from a strategic perspective. Because I think people get confused. There's this running notion within the property market that investment is passive or it's sort of a set and forget strategy, and you put your property manager in charge and, you know, hey presto, you've done it. You just wait for the money to come in. But the reality is it's not like that, is it? It doesn't work like that.
It doesn't work like that. Actually, Lexit is doing a good job of opening eyes from investors about that, essentially, because a property manager, essentially they run a building or they run a property and the operational side of that. But they are not looking at the strategic side, which is something that actually Lexit helps you a little bit to do. And that's a big problem today, I believe, especially with the small landlords or maybe smaller investors in the UK, for example. I mean, you will never think an institutional investor like, I don't know, British Land or BlackRock, buying a property in central London and not having an asset manager, just appointing a property manager and forgetting about that. Well, that's essentially what happens in the market today. You get hundreds of thousands of landlords buying a property and thinking that the property manager is going to be looking after the best interest. And don't get me wrong, property managers, I will say most of them are very honest people, but they are thinking about the operational side. They are not thinking
Yes.
about the strategic side of the investment. They are not thinking about it as an investment, essentially.
That's right. I think where the distinction is, and we sort of draw in our mind, is that a property manager is reactive. They're responding to a situation that needs to be done. So, for example, the property's empty, they go and find a tenant. There's a broken pipe, they will fix the pipe. They will do all of those sorts of things to make sure that you are compliant, your property is full, and that they're dealing with the day-to-day management of the tenant. But that's only part of the puzzle, if you like. There's another whole other part to it, and that's why we really built Legsit, is because we can tell, right? We speak to a landlord and we'll ask them, what's your net return after tax, or what's your debt coverage ratio? And as soon as they give us that blank look that
Yeah.
I don't know, I don't even know what that means, we instantly know that they're probably in trouble, and that they're at the best possible scenario, their property is just not costing them any money each year.
Yeah.
And I think that's the issue. And I think what I really wanted to talk to you today was those different elements of what an asset manager does. And it doesn't mean that a landlord can't perform this function themselves, but they really need to be thinking about it, because somebody at the end of the day needs to think about the asset management strategy. So the first thing is the debt management. And I think that's really critical, isn't it? Because debt doesn't stay the same the whole time. You've got to plan the debt. And so maybe you could expand on what you do in that space and how you look at debt.
Yeah. Yeah, and going one step back before I go into that, I think it's very important what you're saying, because anyone actually can be a property manager or asset manager. The question is if you have the knowledge and if you are in the market that actually you're investing in. And that's the problem of most landlords. They believe they know what they are doing when actually they are totally blind about what is happening with the local regulation and many things in the specific market where they're investing. And one of the things here, and from an asset management perspective, is, again, treating this as an investment. And because it's an investment, there is equity, and many times there is finance behind. And you need to look after, is the investment performing, yes or no? How good is this investment performing, and what things can you change or can you improve? For the long run, when you are thinking at the same time about the exit, about the increasing value of this investment, because as you mentioned before, there is no such thing as passive investment in property. That doesn't exist. If you want that, just buy a bond or something like that. But if you're in property, there is no passive investment. Someone is taking the responsibility. And that's it. And by the way, the legal responsibility is always on the landlord. Yeah. So that's the other thing. You need an asset management, actually, if you are overseas, that is looking after everything for you. Otherwise, you're going to get in trouble at some point. And one of those things is finance. I mean, when an asset is performing or underperforming, and I believe we have a very good example of what is happening right now with the UK, where interest rates went up. And you have many landlords essentially renegotiating their debt right now at interest rates 4 or 5% higher than the historical levels of probably the last 20 years. Then you have a problem. You have a huge problem. Why did you wait to start with for 5 years to do that? Why you didn't renegotiate your debt 2-3 years ago when interest rates were going up? Did you screen all the market? Did you look at the best options to finance this? And that is the job of an asset manager to start with. If you are overseas or if you have a portfolio and you don't have the time to look after that. And also there are other things very important about that. And I bring this into the conversation with every landlord as well. Maybe because I have a more conservative approach on this, which is that debt can be 80%. Loan to value. It can be 90% loan to value. From my perspective, not even 75% loan to value. It's too high. But what has been happening for the last 5 or 10 years is that many landlords, they've been leveraging their portfolios maybe too
Yeah.
much. Why is that? Because they've been following the advice of the mortgage provider or other people, and not an advisor that is actually sitting with them. Today you have in London, especially London, I would say, but all around the country, price drops probably of 20%, 30%, or even 10%. When you renegotiate that debt, the problem you will have is that you don't have enough equity now
Yes.
to keep going forward, and you have an asset that is underperforming in many cases, especially with small landlords, with negative interest, internal rates of returns.
Yeah.
So
And,
what do you do
and,
with that?
and that's what we sort of always say, that your investment needs a sort of start, a middle, and an end, right? It's
Yeah,
not these aren't linear. And I
yeah,
don't care sort of how big or small you are as a investor and what type of property is. You've got to be thinking about that. And I think the issue we've seen a lot of is that many landlords took on too much debt at the time that interest rates were very low. They didn't have a plan to actually say, well, what happens when interest rates normalize back to, say, a long
yeah.
run interest rate of, say, 4 or 5%, maybe higher. And what's our plan in between to pay down the debt? And if nobody's performing that function, and you've simply got the agent telling you now's a good time to buy, prices are only going to go up, or whatever the case might be, you've got a mortgage lender that obviously, they get paid to lend money. They're going to keep doling it out. And then finally, you've got a property manager that's sort of, making sure that there's a tenant in place and the work is being done. But the reality is there's the leverage bit that falls in the gap. And what we've seen is that these investors weren't really thinking about, well, actually, I'm geared at 80% loan to value. How do I get it to 60 in a 3-year window in order to make sure that I'm not over leveraged at the point that either there's a negative market cycle and, the value of my equity goes down relative to the property value, and therefore so too does my loan to value, or alternatively, just as easily, interest rates go up and my return is actually compromised. And it's having a plan for what that looks like, but then also tracking it each quarter and saying, what is my current loan to value relative to the property and my debt rate? And do I have the right debt? Is it the right situation? And I think that's that really important function
Exactly.
initially that most landlords need to understand. And obviously that's something you
Yeah,
do.
that's something we do essentially, is to provide that kind of insight of what is happening with their asset and their investment every quarter, but also what is happening with the market, what is happening with regulations. And you mentioned something there that I think is very important, which is, the agents, that they are very good and they are essential, they will do what you ask them to do, essentially, which is rent the property and collect the rent and fix the boiler. That's it. But they will not flag you what you didn't know or what you didn't ask about. And that's the main problem. So what happened with landlords, and again, we are talking about the smaller landlords, not institutional ones, they tend to follow the hype.
Yep.
So if everyone is buying property, prices are going up, and everyone is getting loan to values at 80%, then they keep doing it as well. The question is, when you took that decision 5 years ago, 10 years ago, were you there talking to a professional asset manager with experience in international markets that understand what might happen when this cycle ends?
Exactly.
Most of them didn't. So,
No.
and you see what is happening in the UK with so many properties for sale. And I would say probably the main reason is that it's not even the new regulation, is that interest rate went up, and yeah,
Yeah.
they need to
I,
get they need an exit.
I completely agree, and I think what I also would say to people as well a lot, which people find quite annoying, is that people will blame tax for the reason that their investment doesn't work. And I've got two things on that. Firstly, the tax was announced many years ago, so you've had a long time to plan for it. But two, if you need to financially engineer your investment just to make it work, then it probably wasn't a very good investment in the first place. You need a positive return initially to start with. And I think the other thing as well is when you're looking for an investment or thinking about buying a property, I also think buyer behavior is really important too, because what happens is investors are also passive in the way that they buy property. And what I mean by that is what they'll do is they'll say, I'm in the market, so people come and bring me opportunities and I will look at them to work out whether I want to buy it or not, which I think is completely the wrong way to do it. I think what you need to do is say, I want to buy an investment that does X because this is the outcome I seek. I am going to go to the market to look for a investment or a property that performs that function, knowing that I'm then going to track whether or not it's doing that. And I think that to me is really critical when I sort of say the investment needs to start. That is the point of the firing gun when an investor goes out. They really need to have that in mind. And I think that's just the biggest mistake we see every day is, you know, the quote unquote accidental landlord that just ends up with this property. Well, the reality is you sat there and let yourself be served opportunities rather than filtering, and you won't get this analogy because it's very Australian or English, which is like cricket, which when you play cricket, you've got to play. Investing needs to be like test cricket, where you let more balls go past you than try and hit every single one. And I think that's what investors try and do. They see the ball and they try and hit it. But the reality is you should be ignoring 90% of the investments that get sent to you and just go out and look for the ones that work.
Yeah, and I 100% agree on that. And there's a big problem on this, because at the end, many landlords, and these accidental landlords in many occasions, what they did is they invested in something that it was offered to them.
Yeah.
And specifically by big developers or agents or agencies from, in this case, from the UK where I'm based, but it can be from any country. Mm-hmm. And they get a beautiful PDF or booklet, very shiny, with beautiful photos, and then an Excel or some financial forecast. They look beautiful as well, with rents that probably they're not going to be achieved ever in history, but that's what they see. And there is no real analysis. There is no someone actually sitting with them and looking at that locally and telling them this is a good investment or not. So the incentives are not aligned between the investor and the landlord and those who are actually offering them the investment. Exactly. So the question here is, who is on the landlord side then? Because once they have the property and they did the investment, the seller forget about them. Usually they offer some property management, but again, it's just collecting the rent.
Exactly.
But that's it.
One of the things I really sort of noticed as sort of somebody that ran a very big agency for a very long period of time is that we would sell about 10,000 apartments and houses a year in Asia to principally Asian investors buying UK, Australian, American, Canadian properties. We never, ever went back to that investor and said, how's your property performing? Ever. We never did, because we'd moved on to the next one. And I think that's the way really that this real estate investment market is changing, because so many of those people have lost so much money with the changes in the market that you've really got to go out and look for something than, you know, be somebody that served opportunities, which kind of segues me into sort of the next part, which is really the regulation. Because one of the things that we're seeing not only in the UK, obviously with the introduction of things like Section 24, the Renters' Rights Act, the new EPC rules, a whole bunch of new legislation coming down, also starting to see Australia follow the UK with that sort of legislation, is the regulatory environment. Because as a landlord, if you don't have one eye into what's happening in the future, it's impossible to respond. And the issue with real estate is it's not liquid, right? I don't care what anybody says. You can't just put your property on the market and sort of realize your capital gain. It takes maybe 12 or 18 months to plan that. And if you're not thinking about what's happening in the regulatory environment and how it's changing and what impact it's going to have on your investment, then you're going to be behind the ball, and it's going to be an issue. So what have you sort of seen in that space, and how do you think about that regulatory space?
Well, I think you're right. I mean, it's important to plan here and to have eyes in the ground, essentially, to understand what is the regulation and how it's affecting your investment. And I think it's not even part of the regulation. It's not a new regulation, for example, but this is a very good example of not understanding the local market, which is the APC rating, for example. Many properties in the market. I mean, I receive properties every day, and different developers and agencies sending me properties for our investors. And when I look at them, many times the APC rating doesn't qualify
Yeah.
for what is coming, but they are just trying to sell. So the big question there is, okay, if they send that to an international investor that doesn't have a clue about what APC rating is, and what is the new regulation coming, it's going to be in place very soon, essentially. It's just a couple of years, and then you are into that.
Yep.
What is going to happen with that investment? So it's very important, essentially, to have someone on your side
Yeah.
looking at this kind of regulations so you can plan going forward. With some of these regulations, they are going to probably damage the investment for some landlords. For some others, it's going to be a booster.
Yep.
It depends on how a good landlord you are and how prepared you were for this. And that's the thing. Prepare yourself as a landlord. Look at what is happening. If you need, for example, I mean, with the new the abolishment of Section 21, that's a game changer. So how are you going to plan going forward the rental of your properties? Which market are you going to focus on? What kind of rents or what kind of contracts are you going to have? Do you want to go short term? Do you want to go student? Do you just do you want to keep it just in the market as it is? Rents are changing as well because regulation. And as a landlord, you need to understand what are the unintended consequences of those regulations, so you are in place to act quick and make some movements. But I mean, having said that creates a bit of chaos, but also because that and the lack of liquidity in this moment in the UK market, which is very different of what it was 5 years ago or 10 years
Yep.
ago. 10 years ago, I mean, you would put a property in the market and in 1 week you had a buyer. So it was extremely liquid. Right now it's not. So from that perspective, it's opening an opportunity, probably a lifetime opportunity for those investors that are more liquid to go and buy
Yes.
property at huge discounts. Again, thinking in the long term. This is not a short-term game. Please, whoever look at this conversation, don't invest in property if you think you're going to make money in the short term, because it doesn't work like that. You need to plan. And it's a long-term investment.
Yeah, no, and I think that's really important. I think one of the other things that's really sort of going to be more and more important, I think, on the regulatory space, and I think it doesn't get enough attention, is the introduction of Section 13. Because to increase the rent now, you are going to have to issue a notice to the tenant.
Yeah.
Not only are you going to have to issue a notice, you're going to have to be able to understand what the market rent is. And what the market rent isn't what is on the Rightmove and Zoopla portals. It is the rent that is being achieved with a tenancy agreement for a similar property type in that location, similar quality, etc. And I think that is going to be the real issue, I think, that a lot of landlords are going to face, because I always hear my property's under rented compared to the market, but they don't really know that. They've got no idea. So they're going to face two issues. Firstly, it's actually serving that notice and working out what the market rent is. But then secondly, what happens if the tenant disputes the rent, and how long do you have to wait to go to a first tier tribunal to get the rent agreed? And I think most landlords are mistaken if they think that the first tier tribunal is going to be on their side, because I think it's going to be exactly the opposite of that, right? I think as a chartered surveyor and evaluator, I know that most of us are extremely conservative, and what we're not trying to do is set market records of rents or capital values. And if anything, we're going to be more conservative in terms of our estimation of what the market rent is, rather than just look at a portal and say, oh, there's 5 other properties for rent in that market that look similar. That must be the rent. And I think that's where a lot of landlords are going to come unstuck. And we've certainly seen that on some of the work we've done in places like Manchester and Liverpool, where ultimately the market rent's probably going down because the student populations in those markets are leaving, and there's more supply than there is for demand. And that's probably a very different story to what a lot of agents and people in the market are saying. But certainly our experience is that it's not all sort of flowers and champagne in the rental market.
It's not. It's not, and that's the thing. I mean, you look at any report from a big institution or marketing agencies, I would call them, and they show you a totally different story. But if you're in the ground, actually you understand what is happening. And again, I think there are great opportunities for investment, but also you need to understand what is happening then. Without understanding, it's better not to do anything. It's just you just don't go in if you don't know what is happening and what is happening in the market. And in general in the UK, we don't know. Obviously, we can't see the future. We don't know what is going to happen for the rest of the year. But with this new regulation, the rental market is shrinking in terms of the number of units available. So that's an open question. I mean, we don't know what is going to happen. Are rents going up because we have a lower supply or less supply? No idea. Because we have other issues like, for example, the one you just mentioned, Section 13, where we don't know if landlords are going to be able to increase those rents or not. But as a landlord, you need to understand that and you need to know. And that is where the job of asset management and companies like ours actually can add a lot of value, because you aggregate different landlords and more properties under your own oversight, and it gives to those landlords or investors some power, I would say, or negotiation power to make changes. But if you're a landlord with 5 properties, I think it's really, really difficult. It's really difficult today, even if you own a block of flat. So how are you going to do it if you own a few properties?
Exactly. And I think, agents are like lawyers before you go to court, where before you appoint them, they're always going to say, the market's amazing. We're definitely going to take it. We'll get a tenant. It's going to take us a week or two. Don't worry. It's going to be amazing. And then once you've signed the agency agreement and appointed them, and then you start seeing that you're not getting the responses to the portal inquiries and all that sort of stuff. And it is taking a lot longer. And obviously this is much more difficult with the whole building, because especially if you have, say, a student building where you get, everybody leave at the same period of time and you've got to refill the entire building. That process is actually much longer than what people say. And I think obviously we've experienced that ourselves, but that's the thing I think landlords really need to understand. It's not, the rental market as a whole is good, and there's definitely demand from tenants, but it doesn't necessarily mean that therefore means that you're going to have 100% occupancy, and the minute you have a vacancy, another tenant's going to walk through the door and pay you what you were getting, or even rent the property.
It doesn't work like that. It doesn't work like that. And also, what kind of tenants are you attracting? And you need to look at all those kind of things. Because the agent has an operational mandate. They need to get a tenant into the property and collect the rent. That's the main mandate. And obviously, there are more things. I mean, if something breaks down and other things that they are in charge. But that's it. They are not looking after the investor or their investment itself. They don't look at that as an investment. They look at that as a property that needs to be rented.
Exactly.
That's the main problem. And I think it's a judgment problem from investors, that they believe that buying a property is only that, but it's not. What happened, for example, if your property is deteriorating over time and you're not fixing it or making the investment, doing the investment that you need to keep it actually at a good standard, which is the case in general. That is what happened with landlords that they don't do asset management.
Yes.
5 years later, you can't sell the property, you can't rent the property, and you're losing money.
Yeah,
What do you buy?
you see that all the time, I think, in the UK. And
Yeah.
I always say to people, you need to have a budget for maintenance, right? And, people have got various rules of thumb, half to 1% of the capital value of the property, 5% of the rent, you name it. You put whatever number you want in that box on your spreadsheet. But the point I make to people is you need a number, because at the end of the day, you might not spend any money on the property in 1 year.
Yeah.
But give it 2 or 3 years, you'll spend all of the money that you should have spent over that period of time just to get to the point that it needs to be rented again. And I think that is probably the biggest issue with UK housing stock, is just generally the quality is pretty low. And it is because I think as a consequence of things like Section 24, where landlords have been squeezed. So the instant thing that most landlords do is they say, well, I'm going to stop spending money on maintenance because my return has been squeezed. But that's actually probably the wrong thing to do. It's probably more of a way of thinking, say, does that therefore mean that this property no longer works? Maybe we should sell and take the hit on capital gains tax and do something different with the money. Or maybe we just accept that we're going to have a lower return for a period of time until we do something else. And I think that's really, really important.
And that brings you back to the finance and funding question you were asking at the beginning. I mean, if you leverage your property at 50 or 60%, then you will have enough equity. If you didn't have money, to maybe repair your property and do something with that. But now that you are leveraged at 80% or over leveraged, there's nothing you can do.
No, exactly.
The problem. So it was the decision at the beginning.
It was, and that's why. So generally speaking, we are telling investors to go in at a 60% loan to value, because that really, to me, is kind of where it starts to make sense. And if you are at that sort of 80% level, the problem is when things go wrong, they're magnified with leverage. And I think that's one of the big keys. I think the final thing I would sort of wanted to touch on with you was the sort of portfolio level thinking, because I think probably most landlords think, I'm going to build a portfolio over time. And that it's, I would say the classic investor that we sort of come across is somebody saying, it's a retirement fund for me, I want to live off the rent or whatever, which is totally fine. But in order to do that, you need a portfolio strategy. And I think that is probably the sort of the final thing I think that most people underestimate and don't plan. And it's sort of, when you're not doing the asset management and tracking performance, it means then you've not got the capital to redeploy to build your portfolio. And so all of these things sort of mount up and make the situation much, much worse. So do you sort of have any sort of things on portfolio planning that you think that people need to be thinking about?
Yeah, I think, well, obviously, any portfolio, any investment has to be built around the level of risk tolerance that someone has. And in that sense, I think property aligns very well to a more conservative kind of approach. The problem is people looking at these portfolios in a way that they believe they are going to perform at a higher level than any other investment because they are over leveraging them. So when you are thinking about portfolios, I think it's very important to think, first of all, local geographies, and how you're gonna spread risk within a country. If you are a UK investor and you just want only to invest in the UK, well, you have to think very well what kind of return you want and what kind of risk or exposure are you having. And in the UK, actually, you can build a very healthy portfolio, combining London and some cities up north, and with different kind of assets as well, not only residential maybe. But from my perspective, in what we do, a portfolio has to have these probably main three components, which is geographical distribution, it's essentially geographical. A portfolio needs three components. One, geographical diversification, political and economical diversification, and then you need a currency diversification. With those three, you're going to build a healthy portfolio that probably will go through storms and through problems in a quite healthy way. And also, let's not forget, when you do that, the way how you leverage your portfolio is not only in your local market, you're also using your debt capabilities in other jurisdictions.
Yeah.
So those three components are essential. And obviously, on top of that, you need to be super aware about the legal and tax, I would say, consequences of doing that. And to do that, you need someone that knows how to do it. So you can take advantage of that.
Yeah, I agree. I think navigating that bit is very, very challenging, and if anything, that's going to become more complicated over time, especially if you look at sort of some of these developed economies that have got, let's face it, places like the UK where there is debt is expensive in the UK for the government to borrow.
Yeah.
Let's face it. They're not generating much in the way of revenue anymore compared to what they're spending things on. So, it's very hard to hide property. You can't move it. The governments like them because they can tax them. And I think more and more, some of these UK investors probably need to be thinking diversification. Okay, I've got the UK. Maybe the best thing for me to do is not buy another property in the UK. I should be thinking about another market. And hence why we sort of set up an office in Abu Dhabi to give UK investors that alternative. Because, just growing specifically in a single market means that you're highly exposed to what happens in that market.
Yeah. Yeah, exactly. And that's the thing. I mean, you need to start thinking, especially in the world today, how it is. And we're in a crazy world. I mean, a lot of things are happening everywhere. So there's even a better reason to actually start diversifying and trying to move to different countries. And still, I believe with what is happening and all the volatility everywhere, for cash buyers or equity buyers, it's a great opportunity. It's a great opportunity.
Absolutely.
Debt is expensive. If you can afford it, buy property, negotiate in a very aggressive way, and you're going to see the results in a few years.
Yeah, I couldn't agree more, and I think I do agree, and I think we both share the view that we're both very long London as an investment. Yeah. The issue is it obviously requires a lot of capital. You can't be over leveraged, and probably most investors are going to have to top up every year in the UK if they're exposed to London assets. But at the same time, you can buy a central London property, pick your asset class, for probably a 6% gross yield today. And I can't remember a time that I've worked in the property market that's been possible. So I do think it's a good time. I think it's a good time for people to think about that. And things are changing. So you really need to understand what you're doing, what your plan is, and then most importantly, making sure that you're achieving your plan. And if your plan isn't being achieved, what you can do to fix it. And I think that's really, when we talk about the role of I call it project sponsor, but asset manager or something like that, that is the critical component I think that people like you bring to this part of the world.
Yeah, we are just like that essentially. We're general partners with our investors, and that's what we're looking for essentially for the investment and the portfolios and how they can achieve a better performance at the end of the day. And let's not forget, we are looking after people as well. We're providing housing if it is residential investment. So it's important to look at both sides, because that is going to give sustainability to an investment. If you are not giving a good product, it's not going to be a good performer over time. And London, I think, is a great opportunity for cash buyers.
I agree. I'll always be longer. I couldn't agree more. I think well, I think even in this part of the world, we're sort of starting to see a lot of people say, actually, London looks quite cheap now. I'm not interested in going outside of London, but the London market seems like it's an interesting space. So I do agree with that. I think it's a combination of having some high yield and some sort of long-term growth, and London probably provides the other part of that for an investor that wants to have a bit of both.
Some stable investment, long-term, strong a strong asset, essentially in central London, which is the gold standard.
Yep.
And you're not gonna buy that cheaper ever again in our lifetime, I believe. So, but I might be wrong, obviously. But when you look at what is been happening with London in the last 20 years, I can't see a better opportunity.
I agree. No, I really do agree with that. Okay, well, I think that's probably what we've got for today, unless you've got anything else you want to add to the role of the asset manager.
No, it's just great to talk to you, and thank you for having me in your podcast.
Thank you very much. Really appreciate your time, Jaime. So Jaime Moreno, I'm going to leave your contact details and details about your business in the show notes. Thank you very much for joining, and we really appreciate it.
Thank you, Ashley. Have a good week.
Thank you.
Take care.
Bye-bye.
Bye-bye.
Right, thank you very much. That was our third episode of the Angel Bricks podcast, the podcast designed to help everyday investors make better real estate investment decisions. If you like our episodes, please share them. We're obviously very small. Like, subscribe, do whatever you do with social media. If you've got anything you'd like to cover, please let us know. We'd love to cover it. We know a little bit about property, various different markets, tax treatments, legal things. If you know somebody that you think should be on our podcast, please let us know. We've got a whole bunch of really interesting people coming as well. So we're really focused on people that are involved in the nuts and bolts of the property industry, but we want to go beyond agents, property managers, those sorts of people. We want to bring people that actually are ingrained in the fabric of how real estate works, and that can bring a bit of different perspective. And something that really, what we're trying to do is bring an institutional view to local investors, so smaller investors, so you can think about it a bit more like how a fund manager would. So thank you very much. I really appreciate you watching if you got this far, and I'll see you on the next episode.